You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the deep dive. Thank you for setting aside this time for something, well, truly critical. Because today we're tackling what is probably the single most financially significant event in the life of an entrepreneur. Selling your business, it's a moment of immense reward, but also intense pressure, complexity, and risk.
It truly is. And it isn't just a financial transaction, it's a profound transition. And the difference between a smooth, profitable sale and one that, collapses or dramatically underperforms, it often comes down to how well the seller prepared for the inevitable risks.
And that's our mission today. We're taking the most crucial insights from our source material, a specialized risk analysis focused heavily on the Canadian market, to give you a shortcut to understanding the potential pitfalls. We want to make sure that if you're planning an exit, you have the knowledge to secure a successful outcome. We are drawing today on the expert analysis provided by the Shaughnessy Group.
Absolutely. And we aren't here just to list potential nightmares. We want to demonstrate how all these top risks, from financial scrutiny to emotional fatigue, are manageable. The foundation of a successful exit is built on careful, proactive planning and, frankly, leveraging specialized professional expertise.
Okay, let's start right at the beginning then. The moment the buyer starts scrutinizing your books, this is where the deal often begins to, crumble if the seller isn't prepared. We're talking about the deep dive a buyer performs, often called due diligence. Why is this stage so dangerous for the seller?
Because the buyer is looking for reasons to justify paying less, or just to walk away. They're doing a forensic audit of every corner of your business, your financials, your legal contracts, even supplier agreements. The main danger is them finding any previously undisclosed liabilities, any ongoing legal issues you might have sort of forgotten about, or just discrepancies in the historical financials.
So if your internal bookkeeping was, let's say, less than perfect for the last 3 years, the buyer's audit will expose that, and suddenly they have leverage to drop the price.
Exactly. Or, worse, they find a material breach of contract or an unmanaged environmental liability, and the entire transaction just hits a wall. The buyer isn't just auditing the past, they're auditing the risk of their future purchase.
But isn't hiring another consultant just an added expense? Why can't the owner just trust their own CFO, who presumably knows the business best, to prepare the documents?
Because the CFO has a bias, and they almost always lack M&A specific experience. The mitigation strategy here is to be proactive. Smart sellers hire an experienced mergers and acquisitions advisor to conduct what's called pre-due diligence. It's a dry, run-objective third-party audit of your own house before you put it on the market. It finds and fixes the issues the buyer would inevitably find.
So you remove their leverage before they even have it.
Precisely. It turns a potential weakness into a strength before negotiations even start.
Speaking of making your house legally sound, once the financial house is in order, we shift our focus to compliance. That moves us to the complex world of legal and regulatory issues, and this is where the Canadian context adds an extra layer of difficulty.
It adds immense complexity. Selling a business involves navigating federal requirements, sure, but also intricate legal, tax, and regulatory requirements that are highly provincial. You might have excellent compliance in Ontario, but if you have a satellite operation in Quebec or Alberta, you need a specialized legal review for that specific geography.
Can you give us an example of how that provincial variance might unexpectedly affect a deal?
Sure. Think about environmental impact assessments or specialized labor law. If you operate in resource extraction, the regulatory requirements in Alberta regarding land use or environmental permitting might be vastly different from what's required in the Maritimes. Failing to comply or just missing specific provincial licenses can lead to costly delays.
Or worse, post-sale penalties that the seller ends up on the hook for.
Non-negotiable, yes. You need legal professionals who live and breathe M&A to prevent those unseen complexities from snagging the deal and draining time and resources.
It seems the entire preparation stage is about making sure various parties, the buyer, the government, don't take a massive cut. Which brings us perfectly to the biggest financial ambush of all, tax implications. This is the one that often determines whether the exit feels like a massive win or a massive letdown.
Precisely. Selling a business in Canada, especially one structured as a corporation, triggers significant and often very unexpected tax consequences. This whole risk really boils down to the transaction structure, specifically whether the deal is a share sale or an asset sale.
Those two terms sound similar to a layperson, but they have hugely different impacts on the seller's final net proceeds, correct?
Vastly different. In a simplified nutshell, A share sale is generally seller preferred because you are selling ownership stakes, often qualifying for the lifetime capital gains exemption, which leads to lower taxes. In an asset sale, the buyer is acquiring the specific components, equipment, contracts, inventory, and the proceeds are taxed differently, often incurring much higher corporate tax, leaving the seller with less.
And the buyer usually prefers the asset sale. I'm guessing because they get the tax depreciation shield and avoid inheriting your historical liabilities.
Exactly. So right there, you've got a fundamental negotiation conflict. If you don't plan meticulously with specialized tax professionals before you even set the sale price, you could agree to an asset sale structure that costs you millions in unexpected tax liabilities. It can effectively reduce your proceeds by 30, 40, even 50% overnight.
That makes the tax advisor maybe the most important line of defense in the prep phase. Okay, let's pivot away from internal audits and structural planning and turn to the external gauntlet and the deep human element of selling. Let's look first at market conditions. How much control does the seller actually have over this massive external risk?
Very little direct control. Market conditions are kind of like the weather of business. You have to monitor them, but you can't change them. We're talking about everything from general economic downturns to sector-specific changes like technological disruption or shifts in legislation.
I can see how a sudden regulatory change or a new competitor entering the market could, have your valuation overnight.
Absolutely. If a major economic indicator shifts or your industry suddenly matures, the buyer might feel your company is fundamentally less valuable than it was 6 months ago. The actionable insight here isn't just monitoring the market. It's about timing the sale, or at least being ready to quickly adjust expectations to maximize the value you can achieve in the current climate.
Let's move to a risk that the seller can control, but often mishandles. Confidentiality concerns. Keeping the deal a secret seems obvious, but what's the catastrophic cascading danger if there is a leak?
The danger is the destruction of the very value you're trying to sell. Premature disclosure triggers rumors, and rumors lead to paranoia. Your best employees, the ones who make your company run, may panic and start looking for more stable work elsewhere. Your most loyal customers might jump ship to a competitor, concerned about the new ownership's commitment or capabilities.
Like your head of sales leaving because they're nervous about their new role and they take major client relationships with them. That just destroys the continuity a buyer is paying a premium for.
Precisely. It damages employee morale, strains crucial customer relationships, and affects market stability. Confidentiality has to be maintained at all costs, which is another reason the M&A advisor is so essential. They act as a crucial shield, managing all information flow under strict non-disclosure agreements, creating a buffer between your company's operations and the scrutiny of potential buyers.
This brings us squarely to the emotional hurdles, starting with loss of control. We're no longer talking about balance sheets here. We're talking about the founder's identity.
This is intensely challenging. For many entrepreneurs, this business is their baby. It's their life's work. Relinquishing complete control, not just financially, but over the culture, the reputation, and the staff, it's an enormous emotional hurdle.
Is this where sellers often sabotage the deal? By moving the goalposts or nitpicking minor details that have no bearing on the financial health of the business?
It happens all the time. That intense emotional attachment can make the seller resistant. They may demand impossible terms or look for reasons to kill the deal, not because the numbers are bad, but because they can't bear the thought of someone else running their company.
So how do we mitigate that deep emotional reaction?
The mitigation really focuses on vetting the buyer very, very carefully. It's critical to ensure the potential buyer aligns with the seller's vision and will maintain the company's established culture and reputation. If the seller feels confident that their legacy is in good hands, it makes accepting the transition and the inevitable loss of control far easier.
And if they don't resolve that emotional hurdle, they might fall victim to the true deal killer, deal fatigue. Here's the thing that often derails the transaction. Describe how the protracted nature of a sale can cause personalities to completely implode, even if the numbers are perfect.
Well, M&A transactions are long, brutal marathons. They often stretch 6, 9, even 12 months. As that time drags on, emotions are heightened and tempers inevitably rise. We often see deals fall apart not over $1 million, but over who gets to keep a minor piece of real estate or a specific trademark, simply because both parties are exhausted and ego takes over.
So the lack of an intermediary turns a high-stakes negotiation into a personal squabble.
Exactly. Without an experienced, objective intermediary, you risk offending or being offended over some minor contractual language, which causes the mutual desire to finish the deal to just evaporate. Professional M&A advisors are crucial here. They manage those egos, facilitate objective communication, and ensure the process remains focused on the financial prize rather than the personal squabbles. They protect everyone from their own exhaustion.
That sounds like they're worth their weight in gold just for the psychological buffer they provide. Let's move now to our final section. The risks inherent in the execution of the sale process itself. Starting with learning curve challenges. Why can't a smart, successful business owner just read a few books and handle the sale themselves?
Because selling a business is not about general business acumen. It's a highly specialized skill set. It requires deep expertise in M&A law, sophisticated financial modeling, valuation techniques, and high-stakes negotiation that, frankly, few owners encounter even once in their careers.
And what's the consequence of trying to DIY the sale?
The severe consequence is distraction. While the owner is busy trying to learn deal structure, managing the auditor, and negotiating terms tasks that can take up 70% of their time, they are fundamentally distracted from running the business. The day-to-day performance declines, orders are missed, and the value the buyer is trying to purchase begins to erode. An experienced M&A advisor streamlines the entire process, allowing the owner to focus on keeping the business robust and highly profitable right up to the closing date.
If the owner is distracted, they're certainly a less effective negotiator, which brings us to negotiation risks. What happens if the seller lacks strong negotiation skills beyond just knowing their company's worth?
The consequence is accepting unfavorable terms. This is where the technical jargon hits your wallet hard. Maybe you accept a lower cash amount up front, or you agree to a bad indemnification clause, or, most commonly, you accept an unfavorable earnout structure.
We've used that term earnout a couple of times. For the listener, what does an unfavorable one actually look like?
An earnout means a portion of the sale price is dependent on the business hitting certain performance targets post-sale. An unfavorable structure might include metrics that are impossible to hit, or a time horizon that's far too long, effectively guaranteeing that the seller never sees the final tranche of that money. Strong negotiation expertise is key to ensuring those terms are fair, attainable, and reflect the true value of the business,
which secures the best possible financial return. Okay, finally, we have post-sale transition challenges. The ink is dry, the checks have cleared, but the risk, particularly to the final payment and the seller's reputation, isn't quite over yet.
That's right. A deal signing is not the finish line. It's the start of the transition. A smooth handover is essential for business continuity and for ensuring the buyer is satisfied, especially if there are any funds held back known as holdbacks, or if the remaining payment is tied up in those earnout agreements.
Right. If the transition is messy, if the staff revolts, or the operations seize up, the buyer will feel burned and may try to claw back funds.
Exactly. A poorly managed transition negatively impacts buyer satisfaction and potentially the final value delivered to the seller. Mitigation is all about extreme planning. Clear transition plans for leadership, staff training under the new regime, and maintaining an open professional communication strategy between the old and new management teams for those crucial first few months.
So what does this all mean? We've covered a staggering amount of ground, from immaculate financial records to managing market chaos and dealing with intense emotional fatigue. Selling a business is complex, it's exciting, and it's absolutely filled with risk, but the core message from the sources is clear. These risks are not inevitable. They are manageable.
They absolutely are. The core takeaway we want you to leave with is this. The successful mitigation of these top risks relies heavily, almost entirely, on careful planning and building the right professional team. You need experienced mergers and acquisitions advisors to run the process, specialized legal experts to handle compliance and the documents, and expert tax consultants to protect your proceeds from the biggest government take. These are not optional extras. They're necessary partners for success.
Before we wrap up, let's leave you with one final thought, building on that emotional challenge we discussed, the loss of control. We spent this time focusing on mitigating financial risks, but perhaps the greatest risk is selling your future happiness for a check that doesn't align with your values. How should a business owner truly define success before entering the negotiation? Is it purely financial? Or does the legacy, that company's culture and reputation, ultimately matter more to them? Something to consider as you plan your exit strategy.
That's a fascinating and crucial question that requires real introspection before the process even begins. Thank you for joining us on this deep dive into preparing for a successful business sale. We want to thank the Shaughnessy Group for providing these insightful risk assessments and encourage you to explore more resources on the topic by visiting the website, shaughnessy.group.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.